Welcome to the Leaders Insights podcast. Today's episode, the capital stack decision, how CFOs structure deal financing to control risk and return. The article opens with a number that made me wince. Deals financed with more than 60% debt are now defaulting at roughly twice the rate of the rest. Is the capital stack the thing quietly killing acquisitions?
It's the thing that kills them slowly, which is worse. The capital stack, the layers of debt, equity, and hybrid instruments you pile up to pay for a deal, decides whether you sleep at night for the next 5 years. Get it wrong, and the business can be perfectly healthy, while the financing suffocates it.
Walk me through the layers, bottom to top.
Bottom is senior debt, the cheapest money, first in line to get repaid, secured against your assets. Above that sits mezzanine, debt that behaves half like a loan, half like equity, more expensive because it gets paid after the seniors. Then equity at the top, your own money, last to be repaid, but it keeps every dollar of upside once the debt's satisfied.
So more debt, higher returns. Why doesn't everyone just borrow to the hilt?
Because debt is a fixed claim that doesn't care how your quarter went. Say you buy a company for $500 million, fund it with $400 in debt, and your return on equity, profit divided by the equity you actually put in, looks spectacular in a good year. But the interest bill is the same in a bad year. And if EBITDA, earnings before interest, tax, depreciation, and amortization, basically operating cash, dips 20%, you can breach a covenant and hand the keys to your lenders.
Covenant. Define it before I let you move on.
A covenant is a promise baked into the loan. Keep debt below 3 times EBITDA, say. Miss it, and technically, you've defaulted even if you never skipped a payment. That's how healthy companies lose control of themselves.
The article says rates in 2026 have reset the whole math. How?
2 years ago, you borrowed senior debt at 4 to 5%. Today, you're closer to 8, sometimes 9. That doesn't sound dramatic until you run it on $400 million. That's an extra $12 to $16 million a year straight off cash flow before you've improved a single thing in the business. Deals that penciled in 2023 don't pencil now.
So the fashionable answer is more equity. But equity is expensive too, isn't it?
It's the most expensive money you'll ever raise. People just don't see the bill. Equity investors want 20% plus versus 8% for debt. The difference is, debt sends you an invoice, and equity quietly takes a bigger slice of every exit. The discipline is matching the layer to the cash flow. Stable, predictable earnings can carry more debt. A volatile business should lean on equity even though it stings.
Give me a real example where the stack decided the outcome.
Look at the take-privates that got done in 2021 and 2022 with thin equity checks and floating rate debt. Debt whose interest moves with the market. When rates climbed, firms like the ones behind some retail and healthcare buyouts had to inject fresh equity just to stay on side with covenants. The operating business was fine. The stack wasn't.
Where do the hybrids fit? The mezzanine, the preferred shares.
They're the shock absorber, preferred equity, shares that get paid before ordinary shareholders but sit below debt. Lets you fund the deal without breaching your senior limits. It's pricier than debt, cheaper than giving away common equity. Smart CFOs use a slice of it to keep the senior lenders calm and the founder's ownership intact.
If a covenant breach can sink you, why not just negotiate looser ones?
You pay for it in the rate, and in this market, lenders have the whip hand. What you actually want is headroom. Build the stack so a 20 or 25% drop in earnings still clears every test. If your model only works when everything goes right, that's not a model, that's a prayer.
Give me the one thing a CFO should do before signing.
Stress test the stack against a 25% EBITDA drops. That operating cash falling a quarter. And check you still clear every covenant. If you don't, you're not too aggressive, you're just wrong. Fix it before close, because after close, it's the lender's decision, not yours.
Done. Want to know where you actually stand? Take the CFO self-assessment at mba-training.com.